My next guest says now is a good time to invest in some of the emerging companies listed on the ASX. Well, for more as to how and why, Craig Scheef from Technical Investing, I'm pleased to say, joins me now live from Melbourne. Craig Scheef, thanks very much for your time this morning. Firstly, why? What is it at the moment that you're seeing in that sort of smaller and the emerging company end of the market that's getting you excited?
Morning, James. Thanks for having me along. I think there's a lot of opportunities. There's always opportunities in the emerging stock space. They're often not well followed. There's often a lot of opportunities there. Those stocks tend to be quite nimble, so there's always opportunities there. It's then just trying to find the right pricing metrics for those stocks and trying to identify the ones that have the right characteristics to invest in.
And look, how to go about doing that? I mean, it can be quite difficult sometimes. You know, they're not as well covered, if you like, as some of the bigger stocks, so not as easy for your average retail investor. How do you go about sort of sourcing the good ones from the less good?
Yeah, it's very true. It's not an easy task to do. Like any company, it's really all about the management. It's trying to identify the management, have the right skill sets to deliver. It's the ones that have history. And that's often difficult in new emerging companies where we haven't seen the management before, so it's about building up some trust and credibility. And it's really about those companies setting expectations and then over-delivering on those expectations. If we see companies that can continually do that, then they build credibility, market valuation, and as more and more time you see those management, you can work out whether they're the strategic thinkers and visionaries that we're looking for to take the companies forward.
Is there a time frame that you prefer a company to have been operating or listing? Because I know that you like to look at sort of historical trends, behavioural trends, as well as overlapping technical sort of analysis. So what are some of the characteristics? What are some of the key things that you're looking at when you're evaluating some of these companies?
Yeah, it is difficult with new IPOs and new floats. So with a company that's been around for quite a few years, you can look back at the history and see what they've achieved. What we're really looking for is trying to identify what's their differentiation, what makes them different to their competitors, what might give them an edge in the market that they're operating in, and really what's the company's purpose? Why do they exist? Do they have an ability in the space that they're operating in? And the company needs to also be able to articulate that to the market. If they can't articulate it to people, then you really question, does the company themselves know how they can grow that business? So there needs to be a clear vision. They need to solve a problem. And a good strategy and execution's a good start. What we like to look for, particularly in, I guess, the technology space, is companies that have developed their own intellectual property. We generally won't invest in social media or app companies. It's a bit fickle industry and easier to replicate. So if they've built their own intellectual property and that IP then needs to be highly scalable, particularly on an international basis, and with very high gross profit margins and operating margins. And if they set that in place and it's the right business, they actually may be able to increase their pricing over time as they start to take market share.
And specifically when you're looking at emerging technology companies, where do you like to potentially enter? I mean, there's a lot of talk about how to value some of these companies, particularly if they're not making a profit. You know, people talk about revenue multiples and so forth. I mean, at what point do you look to potentially enter and how do you look at valuations for some of these companies?
Yeah, that does vary on a case-by-case basis because it's really about assessing the risk to the reward. Yeah. So you can invest quite early in a company and at a low price, and hence the reward could be much larger, against weighing up waiting a little bit longer for the company to have more proof points along the way where the valuation may be at a higher point and you give up some of that upside, but there's more certainty. So there's always that I guess risk reward that is really on a case-by-case situation and looking through the individual stocks. I think if the company has a particular tailwind behind it, in that there's good macro tailwinds, it's operating in a sector, the sector itself is growing very strongly, then that can really help and can probably lead to you investing a little bit earlier than you normally would be.
And is there any degree of leap of faith when looking at some of these companies, particularly as they're talking about solutions that they're bringing to a problem that maybe hasn't grown in great scale, but it's seen to be one that is going to become increasingly prevalent? I mean, a lot of these technology sort of applications and technology solutions are quite forward-looking. So I would have thought there's got to be a degree of trust that that market is going to grow in scale as you would hope, or at least as you're being promised.
Yeah, it's very true, and that is one of the difficulties. I think what we look for is then who they're partnering. If you're getting global partners that come in and joining them with their technology, then that's a proof point. So we're looking for continual proof points to validate that the company has longevity, can survive in a different market, and also again that comes back to management. Netflix, when it first started, was a distributor of video of DVDs, and they had to pivot and change to be the streaming service that they currently are. So if we think management have a good product and we believe that they have the right strategy and that they can pivot and move along the way, then it's, you know, there is a little bit of leap that to see that they can keep delivering.
And are you finding many of those sorts of opportunities on the local market, on the ASX?
Yeah, I think actually, look, I've been investing in disruptive technologies since the 1990s. So I've been doing it a long time. And it's quite amazing to see in this current decade, the last 5 years or so, the number of Australian companies that are really taking on the world, partnering international companies, and are doing a very good job at it. Here in Melbourne, we've got a few companies that fit into that category that are taking on the world and doing an exceptional job. A lot of people in the space would have heard of a company called Altium. Yeah. It's a company that has done exceptionally well in that emerging company, probably the #1 performing Australian stock. It was 8 cents in 2011 and it's currently $33. So that's up 400 times over an 8-year period. So it's one of those companies that has done very well. But you can see there you've had to be patient over a long period of time. Back in 2000, the stock was around $6 a share. And it took 11 odd years to where I guess management was over-promising, under-delivering. But even at those low points in 2011, that company was had sales of around $25 million. It lost $7 million a year in that prior year and had about $5 or $6 million in cash. So people were obviously concerned about the company. It was only valued at around $10 million. Today it's valued at $4.3 billion. So identifying the right companies in this space, whilst there's risks, you can see that the upside potential, $10,000 there, would have become $4 million over that period of time. So Altium no longer is an emerging company. They hope by 2025 probably to have 40% of the global market in the area that they operate in. So we're looking at new ones. I'm quite happy to discuss one of those new ones we're looking at the moment that probably fits those metrics that I discussed before.
Which one is that, Martin? Craig, sorry. What in particular is sort of emerging that is fitting some of that criteria?
So a good example, I think, of the company that meeting the criteria we saw before is a company called Dubber. They're in the cloud call recording market, so they record phone calls. So there's a macro thematic there of compliance and call recording happening around the world. And that share also went through a number of years of where it took longer for the technology to get implemented. But they've now partnered global telcos, AT&T, the largest telco in the world. They have a signed agreement with. And they've also signed a company called Broadsoft. Broadsoft was just taken over by Cisco for $2 billion. And it's a company that enables telcos to route and move telephone calls over the internet. And that is a global trend that's happening. So a lot of businesses have IP-based phone systems now, and there's a new technology coming through called unified communications, which is really the merger of desktop phones and mobile phones. Probably a third of businesses today are using unified communications, and over the next 12 months that will probably go to 2/3 of businesses. And BroadSoft was really the company listed on the NASDAQ in the US that facilitated a lot of that. And they've appointed Dubber as their default call recording system globally for cloud call recording. So there's the validation point that the technology works. You've now had 92 global telcos signing onto that platform. Again, further validation. And now it's really up to the company to execute. And having seen what management's actually delivered over the past couple of years, we're seeing them gain more credibility and more traction. When we look at our other criteria, what's the purpose of the technology? Well, it's to become the global default call recording platform. That's a big statement. What's the problem it solves? Well, there's a lot of businesses out there at the moment that want call recording. If you're a bank with 30,000 employees, or you're a local car dealer with 20 branches and you decide you want to call record your phone calls, it's a costly exercise. At the moment, you actually have to put servers in place, put hardware in place, whereas because the Dubber platform was built on the Amazon web server, it was built to scale, it was built to mimic a telco network, so it can scale across a telco network. It's then just a matter of those corporates going to the telco, asking for it to be turned on, and so it's a simple way to do so.
Craig, you made mention before, particularly when you're talking about Altium, about the patience that was needed, certainly, and has been rewarded in terms of the share price appreciation. How important is that when investing in some of these emerging companies, the ability to have that patience?
Yeah, it's very important. Having said that, there are obviously a lot of companies out there that fail to deliver, and if they do fail to deliver at some point, you do have to make that decision to exit. But as long as the company is meeting a lot of those criteria and continuing to grow, a lot of these businesses will take longer. As I said, you can see Altium took a long period of time. Nearmap took probably 7 years before they started to turn back up. Dubber was a private company for several years and has now been in the market for several years before they're starting to get traction. So it does take time, but once those trends are established, once those companies get into the marketplace, and there's several of those have shown in Australia, then that traction can last for a long time, 5, 10 years or more, to where they become very dominant in their space. So that initial phase is the difficult one, and it's why we see a lot of these shares. Altium was a perfect example of once that trend starts, once that momentum continues, it can continue for a long period of time. Investors globally and in Australia at the moment, with the economic conditions being tough in particular, are looking for companies that can grow. Companies that can grow at 50% or more per annum, and some of these are growing at 30, 50% quarter on quarter. It doesn't take too long before investors will start to get involved and push those valuations quite high.
Craig Scheef, it's been a pleasure to talk. Thanks so much for your time this morning.
Thank you, James, for having me.